Hey, welcome to the Mortgage Minute. We've got a special one today because it's December 5th. This morning, the Bank of Canada decided not to raise interest rates. By the time you see this, it's going to be December 6th. So when we look at this, it's very interesting why and how they make their decisions. A week ago, I was saying it's almost a certainty that the Bank of Canada is going to raise rates. Then we started to see an increasing issues out of the oil patch from Alberta. Premier Notley came out and said she wants to cut back production in an effort to raise prices. Cutting back production might help with supply. The lack of supply will increase the price per barrel. But what else happens? When you cut back production, you cut back jobs. And that's a real big focal point. You know, when we look at the economy as a whole in Canada, one of the biggest problems is that there is no such thing as a true Canadian real estate market. There's no such thing as a true Canadian economy. The Vancouver economy, the Vancouver market, the Toronto market, and Edmonton, Calgary are all different. They're all unique. They're regional. And that's where the challenge lies for the Bank of Canada. Because when they make a decision to raise interest rates to cool down the Canadian economy, they're really looking at the Vancouver and Toronto housing markets being overinflated. But in trying to cool down Vancouver and Toronto, what are you doing to the smaller cities like Edmonton, Calgary, Saskatchewan, well, provinces like Saskatchewan, let alone the Maritimes? So today's headline, and again, I pulled this off the internet, oil patch crisis threatens Bank of Canada's efforts to raise key interest rates. Well, this is interesting. An article that goes on and says, it isn't quite a mea culpa that, or 180-degree turn. Mr. Pulitz is definitely trying to walk back the rate hike expectations he planted just 6 weeks ago. In other words, the Bank of Canada is not likely to stop raising rates because of what's happening in the oil patch, but they're going to slow it down. How does this all translate into what's important to you? Well, I've recently written two more articles on the Canadian mortgage market. This one talks about all the different, the changing landscape of the Canadian mortgage market. Send me an email if you'd like to get a copy of this. It explains the new categories of insured, insurable, uninsurable, helps you understand all the rule changes that are happening. The other article that was just released or published in the Western Investor magazine talks about mortgage rates. By the way, ignore the picture. They found an old one of me. I don't know where that came from, but the article is actually really good. Send me an email and I'll send you a copy of both articles. The biggest question right now with the Bank of Canada deciding not to raise interest rates, should you continue to float or should you lock in? I've got answers for everyone, but I can't just sit there and tell you what those answers are here because it's a case-by-case situation. For example, if you got a mortgage in 2015 and 16 and you got prime minus 0.2 or prime minus 0.3, today you can get prime minus 1%. Definitely give us a call and talk about that. If you are worried about interest rates rising, it might be a good idea to lock in, but then again, what's your exit strategy? Because if you float on a variable rate mortgage and you just decide to sell the house in the next 3 to 5 years, penalties on variable rate mortgages are treated differently than penalties on fixed rate mortgages. So there's a lot of moving parts, a lot of decisions depends on what your personal situation is. So give us a call, let us help analyze your mortgage needs. But the good news is you got a bit of a break on interest rates for now. That's the Mortgage Minute for this week. Thanks very much.